Welcome to the AWA Market Minute, breaking down financial, political, and economic events that impact today's retirees. Our investment committee performs hours of research and market analysis every month so that we can share simple summaries with our clients in 30 minutes or less. Featuring top industry experts who share insights on important topics so that our clients can gain understanding and peace of mind on their journey to and through retirement. And now your hosts, Chief Investment Officer Scott Hoxer and Founder and CEO Paul Coles.
Well, hey, Scott, welcome to another episode of our AWA Monthly Market Minute. Excited to be back in the chair again. And we are officially into the fall cold weather.
Yeah, I was up in the mountains last week and in the 20s and acclimated really fast because it's getting cold.
It is, and I'm not acclimated. My wife and I celebrated our 20-year anniversary this last week. We made it 20 years, so we decided we needed to celebrate by going to Kauai, which was a wonderful trip and had a ton of fun. Did a lot of cool hiking and got to go see the Nepali Coastline Trail, got to go up to the Waimea Canyon. I know you guys have been up there before. Just a really cool adventure. But I'll tell you, coming home yesterday to 32 degrees was a cold and rude awakening.
For sure.
One of the things that I do love about cold weather is football. And this week we got high school football here in Utah. In their playoffs are starting. We're getting past that midway point in college football, and I got to thinking a lot about college football. Here in Utah, we've got University of Utah, and their head football coach Kyle Whittingham has been with that team for it's like 25 years now.
Yeah.
He's been the head coach I think for 22 years or something. And it's kind of generally accepted that this is going to be his last season coaching. And it's like the end of a pretty significant era for college football here in the state of Utah.
Yeah, he's such a widely respected coach and has, tenure in a sport where tenure is rare. It's either kind of put up or shut up, and if coaches don't perform, they get shown the door. And for him to last that long and be competitive for as long as he has is quite an accomplishment. Absolutely.
One of the things that's just kind of interesting to watch, I don't think he's leaving for any particular reason other than he's put in his time. But I do think some of these coaches that have been doing this for a long time are starting to say it's time to hang it up. We saw Nick Saban go last year. We've seen other long-term tenured successful coaches say it's time to move on. And some of the kind of the grumblings that we hear about are, today's landscape of college football is just different. It's hard for some of these coaches to want to continue to do what they were doing because they kind of grew up in a different era of college football. And, like it or love it or hate it or just despise it, whatever you want to frame that as, I think we all have to accept the reality that college football looks very different today than it did 10 and 15 and definitely 20 plus years ago.
Yeah, it feels much more like a professional sport than it did, 20 years ago, with the level of preparation for, student athletes, and they're 11 years old and they are being prepared to be, future quarterbacks. And then the inclusion of serious amounts of money that's being paid to the players has changed the game significantly as well.
Absolutely. The amount of money that's involved in the sport now is at levels that's almost unfathomable. We're talking about, tens of billions of dollars that run through college football. It's fascinating to watch the amount of money that goes through the players, the coaches, the programs, what's invested, in the facilities, the TV contracts. It's pretty incredible. And some of the evolution that we've seen in the sport, we've seen one of the big significant adjustments was this transfer portal, where now the players have the ability to go to a university, almost test drive the experience. If they don't like it, they can transfer. They don't lose a year of eligibility. There are several windows where they are able to transfer. It's not even like a one-time window. There's multiple times where they're able to say, this isn't working for me. They can just bounce around between programs now. They can commit and decommit and recommit to different schools in rapid succession. And it has definitely changed, that level of like player athlete loyalty. They can kind of bounce around and say which position, is going to be best for me. And then they added fuel to the fire where for years and years and years, these athletes were seen as student athletes. And as a result, it was like, hey, even if you went to a recruiting event and somebody did so much as buy you dinner, that was a violation of recruiting policy, and programs were having, massive penalties and fines and sanctions brought against them for recruiting violations. If, things like, you were buying dinner and paying for parents to do certain things, big problems. Well, several years ago, as the different programs kind of bound together and said, we're going to enter into these lawsuits with the NCAA and take control of this. And ultimately, they wanted to give some of the money back to the student athletes, and they prevailed, and they've created these, new arrangements called NIL, for name, image, and likeness, saying, hey, we can pay players because kids are going to the stores now and they're buying their jerseys. We should pay those players. We can put them on a TV commercial and sell trucks for the local dealership. We can pay those players. And some of these arrangements are for millions of dollars.
They're lucrative. I mean, for some of these players, it's walkaway money where they can come out of college and be set up for life with their NIL money.
It's crazy.
It's pretty wild. Yeah.
And it's changed the game. You've got players that are really good in college, that the way they play may not translate to the pros as successfully, and they're staying longer in college because they're saying, hey, I'm well known and loved in the community. If I leave to college, I may or may not be able to get that $2 million a year deal I'm getting right now. So you've got players that have stayed longer than they would have stayed years ago. You've got players that are transferring around looking for a good NIL deal who, years ago they would have said, hey, I want to be the third string guy at a big program like Alabama because, I'm going to be coached by the best and be on the program that's going to win the national championship. Now they're saying, I don't want to be that third string guy.
Yeah. I think the other thing we've seen too is it's changed the whole landscape of recruiting, because it used to be identify that diamond in the rough, put them on your roster, have them play for you for their whole career, and that's where you could really, differentiate yourself. Now it's about being able to be a winning program, having, donors with deep pockets, and being able to have that person who had a great freshman season come over to your program.
Yeah. Recruit top talent from the college football ranks.
Yeah.
You're exactly right. I remember years ago, one of the most highly prioritized activities amongst college football programs was recruiting high school kids. And, you'd get these assistant coaches, and pretty much their whole job outside of coaching the D line or whatever it was they did on the program, their real job was to get to Southern California, to get to Texas, to get to Florida, and recruit the top talent from the time they're 15, 16, 17-year-old kids, get them to commit to your program. They would spend enormous amount of time traveling, being in the homes of these families, and trying to get these kids to fall in love with the programs so they could come and play. And nowadays, that seems like a secondary or tertiary kind of priority, because they say, well, I can find that sophomore kid who has shown that he's a highly talented kid. I can pay him. Maybe he's a second at Texas, and he doesn't want to be a second, so he can be a one at one of these other programs and pay him, and he'll swap over. and it's just completely revolutionized, how college football is playing out today. And again, like it or love it, or hate it, or despise it, or however you want to frame that, it's we have to accept the reality that the game has changed, the landscape has changed.
And the really good programs adjust to that reality, rather than say, hey, let's pine for the good old days. They say, hey, these are the new variables we have to work with, and how do we appropriately adjust?
And you're seeing that play out today in really interesting and kind of entertaining ways, from a consumer of college football who, I openly love it. I kind of enjoy watching some of the chaos. I kind of enjoy watching, some of the big programs struggle to find their footing in all of this, because it's fun to, this year we see like a South Florida, who goes and beats 2 top 10 programs weeks 1 and week 2, including Florida, University of Florida, which is, highly decorated historical program, national championships, Heisman Trophy winners, and Southern Florida shows up and takes them down. And you're going, that would not have happened 10 and 15 years ago. It just wasn't even in the cards.
Yeah.
But we're seeing it now differently than we've ever seen it. And the opportunity to adapt and evolve to that landscape allows for some of this, parity in college football, and allows for some of these programs to say, hey, if I evolve with the landscape, I can do some pretty neat things, and create, a little more opportunity in certain areas. And the programs that are saying, I'm not going to adapt and evolve, are really finding themselves in a world of hurt in this current landscape.
Absolutely.
Yeah. So if we go back in time, Scott, and look at the kind of, you started your financial career, 2003?
It was 2003. Yeah, I finished graduate school in 2003. So Coach Whittingham and I started our careers about the same
You're
time.
tenured. You need to.
Yeah, we're basically colleagues at this point, right? But no, it gave me occasion to kind of go back and reflect on what was happening in 2003. And I looked at some of the pop culture references.
Yeah.
Top animated movie in 2003.
2003, I would probably guess something like Toy Story.
So it's actually Finding Nemo.
Okay.
If you can remember that one.
I remember Finding Nemo.
The final installment of the Lord of the Rings series, The Return of the King, was released in that year.
I remember that.
And then one that you probably don't remember is that was the final season of Buffy the Vampire Slayer.
I don't think I would have picked up on that, but I had friends that were into that.
Yeah. And it also, gave me occasion to kind of go back and say, hey, what were some of the top companies back then by market capitalization, which is a measure of how large companies were. And going back to 2003, the largest companies were Microsoft, GE, Pfizer, ExxonMobil, Walmart, Citigroup, Intel, IBM, Johnson & Johnson, and Procter & Gamble. So those were the heavy hitters back in 2003. Any guesses of how many of those are on today's top 10 list?
I think this one I could probably guess is probably just Microsoft.
That's it. Yeah. And those other companies are still viable companies, but they are a fraction of the size of the biggest companies in the market today.
Yeah. I mean, we just had NVIDIA, yesterday cross over $5 trillion in market cap. And 2003, they didn't exist.
Right.
Yeah. Right. The technology they're building now wasn't around at that time. I mean, the company didn't exist. I mean, other companies on our top 10, Amazon, I think they rolled out as half.com. I remember back in 2003 trying to purchase college textbooks on half.com. I mean, to think of what they were and what they are today, it's just completely revolutionized what we do today. The utilization of Amazon on a day-to-day basis for almost every household. And if you flash back 22 years ago, that would never have crossed our minds as, what this would have become.
Yeah. You think about Amazon. Amazon's like such an interesting one because it started out, kind of in the book business. And then we all know Amazon for the retail business and, the online shopping and Amazon Prime and those types of things. Amazon Web Services is a monster. Their cloud computing is just unbelievable to see how they looked at the opportunity set that was in front of them and how they looked into the future and adjusted. Pretty impressive story.
Absolutely. Yeah. And I think, this is a great conversation, Scott, because it sets up this idea that with the evolving world around us, there's a need to adapt and evolve with it. And we've got, hundreds of clients who have asked us, help me get through retirement. Help me I've worked for 40 years to put money into a 401k so that I can reach a point in time where I don't have to work anymore. And I rely on that money to maintain the standard of living and quality of life that matters to me and my family. It gives me the ability to live and give in meaningful and generous ways. And if you don't protect that money and grow it appropriately and spend it appropriately, you could be negatively impacted. And so the need to understand the environment that we're in today, the changing landscape, becomes just punctuated when you're in that vulnerable spot of retirement.
Yeah. And it's been interesting over my career to see how just the investing and market landscape has changed. It's changed very significantly. In 2003, when I began my career, yes, there was complexity in markets, but they were far simpler and there were far more variables than there are today. The pace of technological change has accelerated significantly. That's a huge change that we've seen. The size of the investor base has grown significantly as 401ks have exploded and indexing type investing has exploded. We've seen some significant changes as far as that goes. Capital spending has been interesting.
Totally new.
Back in 2003, companies were buying big machines and hard assets, and now most spending is on software and tech.
Research and development.
Yeah, so we've just seen a lot of developments. And then we've seen more geopolitical unrest. We've seen more political unrest. We've seen more variability in economic policy. So there's a lot of changes that have occurred, in 2025 that makes this market very different than, the 2003 market.
Absolutely. I mean, even looking at the technology used to help us on the trading side. I mean, if we go back 20 years ago, and say, to get access to information that we use to make informed decisions around what we want to buy and when we want to buy it, a lot of us, would still pull out a newspaper in the morning. A physical piece of paper and read about it. Some of that information, especially longer than 20 years ago, 30 years ago, that information would have been published as much as 2 days after the event occurred. If this was something that was an international event, we might not have found out about it for 24 to 48 hours after the international event occurred. And then to respond to that information, you'd have to pick up a phone, send a fax, you'd have to figure out a way to get that request to somebody who could act on that information. And then it took a series of events to be able to execute your request. And then you'd have to wait till the paper was printed a couple days later and read the financial section to know what the values of what your requests actually were doing. And today, with the internet being a global norm, I mean, you could be anywhere in the world and have access to internet now. We can live stream information as it happens in real time. Whether it's a geopolitical event in the far east or whatever it is we're talking about, that information can be accessed instantaneously in real time, and we can turn around and respond to that information nearly instantaneously and in real time, react and execute our instructions in real time. It changes the volatility of a market that relies on people acting on that information. All of a sudden now we see the volatility change significantly.
We do, and we see a lot of kind of crowding into trades. We see a lot of people kind of doing the same thing, and so we'll see sectors of the market be inflated more than others. Right now, that tech space in particular has grown extremely pricey and extremely concentrated, and is priced as though the party in tech is going to continue in perpetuity.
Yeah.
And so there's concerns there. It's been interesting too, thinking back, like '03 globalization was the watchword, and companies were well into the process of having globally integrated supply chains and free trade throughout the globe, and that trend persisted for many years. Right now, we're seeing decoupling. We're seeing the opposite
Amen.
of that,
Yeah.
and so that impacts markets as well. So I think the point with all of this is things change, and as things change, we need to adjust to current conditions.
To current conditions. So one of the big criticisms that we see, we learn about this. We call it the 4% rule, and the idea behind the 4% rule is that back in 1950s there was this Nobel Prize winner that created modern portfolio theory, Alfred Benjamin, and the idea was that you could draw a percentage of your portfolio assets down every year, and given any market condition, you are not likely to run out of money. And it started earlier as a higher percentage, and then by the time you and I back in '03 were going through school, it kind of got whittled down to the 5%, and then eventually 4%, and now with the numbers just all over the place. There's just a ton of criticisms, and we get things like low bond yields make it an unsustainable rule. We get this concept of kind of like rigid one-size-fits-all framework that's like it's not a very efficient way to apply something with so many unique variables that retirees are up against. Things like taxes and fees reduce the income, and taxes are just this constant evolution. We have longer lifespans today than we'd experienced. I mean, think about when the 4% or the modern portfolio theory was published was back in the 1950s. Here we are 75 years later. Retirees today are living 6, 8, 10 years longer on average today than they would have 75 years ago. And so that changes the dynamic of how much money you should be drawing out of that portfolio in any given year. There's global realities today that they weren't up against in the 1950s, where we have a very integrated global economy today. The sequence of returns risk, we're going to talk about that. But then also just kind of the research has demonstrated there are inevitable kind of flaws within this 4% rule. So that research has shown that if you are averaging in a variable portfolio 9.1%, that's our green line here, you have the ability to say, I will take a lower rate of return and select dynamically where I'll take my distributions from. So the green line is a higher rate of return, but taking just that standardized 4% rule across the board. It's actually a 5.2% withdrawal rate, but they're just taking it pro rata across the board. And then the purple line is saying, I will select dynamically where I'll take my investments from. So I have various buckets of investable assets, and I'll just kind of select where that money will come from. Even with a lower rate of return, I can create an outperformance of the longevity of my portfolio, and it's not a small differential, by just being very intentional about dynamically selecting where I get my money from in retirement. So this really opens our eyes up to the idea that as the world evolves, we need to evolve with it.
Agree. And I think investors have been lulled to sleep over the past 5 years on these principles, because when we have had downturns, they've typically been what I call tennis ball downturns, where they fall sharply, but then they rebound fairly quickly. That's not always the case. We'll have downturns that are longer in the tooth, and when those happen, these dynamic distribution principles become even more important. The other thing that we've seen is asset allocated portfolios haven't been as beneficially treated as they have been historically, and so investments in indices have fared well on both the downturn and rebound. That is a historical anomaly, and so those investors who are concentrated in indices and who aren't following these principles, those chickens will probably come home to roost at some point
Yeah.
if they're not kind of adhering to good asset allocation principles and good dynamic distribution principles.
Absolutely. And we're not calling our shot here. We're not suggesting that, the market's about to take a turn and that it'll be an extended duration, but that's going to happen at some point.
It will. Yeah. And yeah, to your point, Paul, I mean, the economic data right now is mixed. There's no, smoking guns suggesting anything like that's imminent, but we know our market history and we know that there will be downturns at some point. And sometimes those downturns are a little longer in the tooth. And when they are, those who've asset allocated correctly and those who are practicing these dynamic distribution principles will still be able to have a successful retirement.
Absolutely. So another principle that we've talked a lot about, but there's just good research now that I like to demonstrate here is if we have an income plan in our portfolio, we're just more comfortable, the research has shown, spending our own money. And I see this a lot with clients where they'll get to a point where they're like, I just don't really want to spend it. And that's fine. If the goal is legacy distribution, then that's fine. But a lot of times it's out of fear that drives that. I don't want to spend my money. And so developing an income plan gives people the comfort and confidence that it's okay to spend my money. Research has demonstrated they will spend their money much more, appropriately. And then the final point here is, if we have our heading, we know where we're going, we're taking the car, we're going from, New York to California, and we have the appropriate vehicle that we're utilizing to travel that duration. You mentioned asset allocation. That's the appropriate vehicle. A well-diversified asset allocated portfolio over an extended period of time has demonstrated that in any 20 rolling year window, from dating clear back to the 1950, you pick any 20 years of that period of time, and that well-diversified portfolio has never averaged lower than 5 and as high as 14% per year on average. Pick any 20 years. So it just further demonstrates, if we have our heading, we know where we're going, get the right vehicle and stay on course, right? Stay on that heading. So Scott, this has caused, you and I to think a lot about, fiduciary based best practices and principles, and then how our clients kind of think and feel about money, and ensuring that we're listening to our clients and the psychology of how they think and feel about money, and then giving them the best vehicles to travel down that journey on. And so, with all that today, we want to kind of outline some vehicles that are very effective in today's environment. Given a lot of the evolution of the market and the economies and what we're up against today, we want to continue to help people see that there are vehicles that can get them to their intended destination and maybe even a little more comfortably than some of the vehicles that they've been used to traveling in. So there are vehicles that have 6 buckets rather than our traditional 4 buckets. We've traditionally utilized vehicles that kind of operate within these 4 bucket spaces, and we're kind of helping people say, well, there are vehicles that have even more buckets that we think could be very, very effective and helpful given today's landscape that we're up against. And so I want to kind of go through these together. And so we've got a liquidity bucket, which, I think we're familiar with, Scott, cash and equivalents. We've got an income ability bucket, which would be anything that kind of has that paycheck substitute. We've got our low volatility buckets, which would be tactical in nature. This would be something where the general theme or idea here is win by not losing, play defense, recognize opportunities to kind of get out before things become problematic. That's what a yellow bucket is designed to do, soften the blow of some of those potential losses. Whereas an equity bucket, that red bucket, it's not even thinking in those terms. It's a completely different concept. It's saying, how do I get access to all of the available, equities? This is my engine. This is what drives the vehicle of growth. and, looking for those publicly traded markets, looking to say, I can get large cap, small cap, mid cap, I can go growth, I can go value, I can go core, and appropriately picking those publicly traded positions. The two buckets that I think a lot of people are just now kind of getting more familiar with, Scott, are these next two buckets, specialty and opportunity. Walk us through what a specialty bucket is.
Yeah, so specialty is going to be complementary assets to the four buckets that you just talked about, Paul. And so what we've seen is there's certain asset classes that will sometimes zig when the market zags. And by having some of these non-correlated assets in your portfolio, it can help you have better, what we call risk-adjusted returns. And so some of these assets might be commodities. Commodities are going to be things like lumber and agriculture and oil and fuel and things along those lines. Another category is going to be currency. That can be actual currencies, that can be digital currencies. So having some exposure to that, having things like hedge funds in small quantities, but having some precious metals, including rare earths. So these are going to be more kind of niche-like categories. And so long as one is, being prudent in having these on the margins of the portfolio, when we test those out and look at how those perform as complements to the portfolio, they can add a ton of value. And some people, would benefit by having some of that in their portfolio. So that's kind of the specialty bucket. The next bucket is going to be the opportunity bucket. And the opportunity bucket is just what the name implies. Sometimes markets present short-term or near-term opportunities where it's not a permanent opportunity in place, so to speak, but in the next 3 to 6 months, there may be some fairly obvious opportunities to take advantage of. One thing we've been watching closely has been defense spending has been going through the roof, with NATO spending requirements going up, and then also with some of the global conflict and the restocking of materiel. We've seen global defense spending explode, and so that's an opportunity that we think is worth for some people taking advantage of. And so, if we can see a short-term opportunity that we can capitalize on that, and 3 months later have another one, doing that with a small part of the portfolio is beneficial. And I think it's important to note, opportunity is different from timing the market.
Yeah.
So, because I think this is an important point. We're talking about 5% of the portfolio taking advantage of opportunity. We're not saying, hey, it makes sense to go all in or go all out. That's never a prudent investment strategy. You want to mostly stick to your knitting as far as your asset allocation goes. But if we can be opportunistic with a little bit of the portfolio, we feel like that gives some opportunity for some outsized gains.
That's beautiful. So, these are thematic, as I understand it, right? So we'll look for themes that are playing out, and being able to say a small portion of a portfolio on the margins might be able to, in a short-term period of time, say we're going to be thematic in something, recognizing short-term trends, and then allowing for a portion of that portfolio to benefit from those short-term trends. Again, not the whole portfolio, but a small portion. And it's kind of been fun to watch as these have played out for some of our clients, because it creates additional, just kind of little bits of alpha in a bigger portfolio that allows for them to say, hey, I'm really being able to generate something of value inside of a bigger portfolio that, it's not any kind of additional excessive risk. It just gives them another access to an asset class.
Yeah, and what we found is we've, kind of looked at some of the data with these, Paul, is if we do this on the margins and to, kind of really define what we mean by on the margins, the first four buckets comprise 80 to 90% of the portfolio.
Yeah.
But with that remaining 10 to 20%, if we thoughtfully and strategically allocate those funds into those other two buckets, we really like what we see as we track the historical data there.
Yeah, no, I like that. So what we have here, and we'll kind of end on this concept, is just some additional vehicles that are helpful as people are saying, I've got my heading, I'm going from New York to California, nothing changes in my heading, but perhaps this vehicle might be a little more comfortable ride for that journey, might be a better fit. Maybe I don't have that cushion, that lumbar. This one gives me that lumbar as I'm making that journey, and it just makes me feel a little bit better as I'm on that journey. And these vehicles are something that I just want to make sure people know are available. to be utilized. And we've named these vehicles an apex model, a capstone model, a keystone model, archways, pillars, and ultimately bedrock. And this is kind of an appropriate asset allocated blend of those different buckets that we utilize. And the concept behind these different models is just an individual's risk profile. So the reason that some might have more of one bucket than another is based on an individual's risk profile, and if they have demonstrated higher capacity and tolerance and for risk, then we'd say, hey, we might look at a capstone type investment model. But if they've demonstrated maybe a lower capacity or tolerance for risk, we might look at a bedrock or a pillars type model. And this takes all of those concepts of dynamic distribution and says, look, as we kind of see up markets, we might be taking positions out of our equity bucket in order to cash flow retirement. We might say in a down market, we're looking at yellow and green buckets to cash flow retirement. If we're seeing disjointed markets, where things don't go the way that generally things tend to go in markets, bonds and stocks sometimes act inversely, sometimes they don't. And when that happens, we have opportunities to look at things like specialty and opportunity buckets to help cash flow some of our distributions for retirement. The idea here is that given all market conditions, we have different buckets that we can draw from to allow for us to stay invested. Long-term heading isn't changing, but also be able to cash flow what's needed to cash flow while staying invested. So short-term needs, long-term goals and game plans. Boy, this has been helpful to clients, as they've seen this. And then these additional vehicles have given a lot of people comfort to say, I want to be able to keep up with the general environment, right? The landscape is changing, and we have to keep up with that landscape. And some of the other vehicles have demonstrated a need to evolve. And so these vehicles we feel like are going to help people keep up with a changing landscape.
Absolutely. And I would just say, as we kind of wrap things up here, Paul, these will be conversations we'll be having organically with our clients as we meet with them in upcoming reviews. These will be discussions that we'll have, and we'll get a little more granular. The principles we've shared today are very general in nature, and we discourage kind of implementing any of these without consulting and talking to us, because the models we've put together, we feel like provide a good way to get access to these different buckets, but any of these buckets in isolation need to be well thought out. So little food for thought.
Yeah, I think that's a great ending point. It's the idea of being the ability to appropriately allocate between those different buckets. One of the virtues in this vehicle, this model, the way we allocate, is the ability to rebalance, because you're going to end up with drift in a portfolio. The target allocation looks like this, but as we take distributions and as markets do what markets do, things go out of target. And one of the virtues in this particular these model sets is it gives us the ability to rebalance at regular intervals, allowing us to get back to target. And so knowing a client's risk profile, building the appropriate model allocation so it's diversified, allocated correctly to align with their long-term goals and objectives, short-term needs, risk profile, and then to rebalance that based on drift and distributions at regular intervals has really demonstrated some effective, comfortable driving when they're headed to their intended long-term destinations.
Absolutely.
So just the invitation maybe to the audience would be, to reach out to the team here at Alliance Wealth. It's definitely something that we want to get more granular with every individual client that we service, and demonstrate, a little more of what these vehicles look like. And if it's the right fit for their situation, kind of walk them through how that implementation could look on their behalf. So Scott, as always, this is great to meet. Hopefully you enjoyed as much as I do. And until next month, thanks everybody.
Thanks.